technical analysis is based on history, right? We look for patterns to see if they repeat themselves and that sort of thing. So as we look at the carnage that's happened over the course of the last day or so, in context of what happened in August, and in the broader context of what's been a nice bull run, what are you seeing in the S&P 500?
Thanks, Tom. Well, look, as you can see here, we've recovered almost the entire pullback from early August, and I think that's the important thing. Technology, which most say is undergoing real carnage, has snapped back. It was the third best performing sector, in the month of August. So we've really seen very little actual true damage outside of yesterday. We did break 55.50. We're down to levels just above 5,500. This area near the open gap is going to be really important. That's 54.63 or so. So my thinking is in the near term, we don't have enough information to say actually that it's going to be a larger decline as of now. We've seen yesterday, which came out of nowhere. We heard weak data out of China, of course. That caused interest rates to plummet. Dollar yen started to pull back. S&P and the NASDAQ broke very sharply. This is going to be the key for the S&P, 55.50 to 54.63 or so. So, not too much damage overall. A lot of this is technology based in terms of why markets aren't at new highs, similar to what this next chart will show, which is the equal-weighted S&P.
All right, so let's clear that and show the equal-weighted S&P 500, because you're saying that's that kind of more broadening type theme or trade that's been going on.
No, this is important for investors to know. Look, technology is 30% of the S&P, but as of last month, we had 5 sectors that made new all-time high closes on a monthly basis. We have technology, financials, healthcare, industrials, and utilities. And so that's really important, is that, on an equal-weighted basis, S&P made new all-time highs as of, the end of last month. And so, to think that you sell a market at new all-time highs, the odds to some extent are stacked against you. Momentum is still positive. Breadth is in very good shape. We have about 75% of all stocks above their 200-day moving average. That's important. Sentiment has gotten more optimistic, as might be expected. We're up 500 points in the S&P in about 3.5 weeks. However, it's not yet too enthusiastic, too complacent as of yet to say, well, this is the top. We're in September. And one other point,
yes,
in election years, September is actually not the worst month. We've always heard September is the worst month of the year. That's true historically. September actually can be better than October, which is actually a lot worse during years like this.
So what's interesting is you're telling us, despite the massive amount of damage done yesterday, we haven't seen enough technical damage to say that this is the beginning of anything deeper or darker in terms of a downturn.
100% correct. And a lot of that is because financials and healthcare, which combined are 25% of the S&P, both hit new all-time highs last week on an equal-weighted basis. We want to strip out all these large cap influencers that really affect the broader averages and look at an equal-weighted basis. Yes, technology is what everybody is still focused on. It makes a lot of sense. However, financials, healthcare, industrials, all working very, very well. Market breadth is good. It's not like 2007, where you had the majority of sectors that peaked in the month of May or June and the market turned down. So the breadth is not all that thin at new highs. It's actually very well supported.
All right, let's clear this and move on to another chart that we see as interesting in terms of a kind of technical perspective, and that's small caps versus the S&P 500. Now, the small caps were a big story just about 2 to 3 months ago with regard to the catch-up trade. What's happening there now?
Well, small caps have indeed played catch-up off these August lows. And when you look at the longer-term trend, this is a ratio chart, IWM versus SPY. But when you look at what's happened just in the last month, we've seen a very nice breakout in the ratio of small caps versus S&P. What does that mean? Well, after, literally the last couple years of underperformance, as part of granted, the last decade of underperformance for small caps, they really peaked in 2014 relatively. They're now starting to really play catch up and kick into gear. And I think that's very, very important. People like myself, I look at counter trend indicators like DeMark indicators. We saw our first monthly buy signal for IWM versus SPY for the first time in over a decade. So look, small caps will benefit as rates start to pull back. We've seen what I think is the beginning of that. Yes, we're in obviously a volatile time, September, October. But I think between now and next spring, we're going to see a nice catch-up trade from small caps and certainly start to outperform. So my target, up near 228 initially, then 244.